Most people believe that becoming wealthy requires a high salary, a prestigious career, or extraordinary luck. They think wealth is something reserved for those who earn a lot of money. Charlie Munger strongly disagreed with this idea. According to him, wealth is not built by how much you earn, but by how you behave over time. Charlie Munger, the longtime partner of Warren Buffett, believed that the foundations of wealth are surprisingly simple. Save consistently, avoid stupidity, invest rationally, and let time do the heavy lifting. These principles apply even, and especially, if you start with a low income. One of Munger's most important lessons is that expenses matter more than income. If your lifestyle expands every time your salary increases, you will never build wealth. Many people earn more money but remain poor because they fail to control their spending. Munger believed that living below your means is not a sacrifice, but a strategic advantage. Saving is not glamorous, but it is essential. Before you can invest, you must first create surplus capital. Even small amounts saved consistently can become powerful over time. Munger often emphasized that the early years are the hardest because capital compounds slowly at the beginning. This is why he famously said that the first $100,000 are the most difficult to achieve. Once saving becomes a habit, investing becomes a natural extension of discipline. Munger did not believe in frequent trading, market timing, or complex strategies. He believed in buying high-quality businesses at reasonable prices and holding them for a very long time. Investing, in his view, is not about predicting the market, but about understanding businesses. This requires patience and rational thinking. Markets fluctuate, prices move unpredictably, and emotions can easily lead to poor decisions. Munger warned that emotional investing is one of the fastest ways to destroy wealth. Fear and greed cause people to buy high and sell low, interrupting the power of compounding. Time is the most underestimated factor in investing. Compound interest rewards those who remain consistent and disciplined for decades. Even modest returns, when combined with time, can produce extraordinary results. The key is not to interrupt compounding unnecessarily by selling too early, chasing trends, or reacting to short-term noise. Another core idea in Munger's philosophy is the use of mental models. He believed that successful investors think clearly by understanding incentives, opportunity costs, and human psychology. Most mistakes in investing are not caused by lack of intelligence, but by poor judgment and cognitive biases. Avoiding obvious errors is far more important than trying to make brilliant moves. Munger often said that the goal is not to be exceptionally smart, but to be consistently rational. This means avoiding debt, especially consumer debt, staying away from speculation, and accepting that wealth is built slowly. There are no shortcuts. Anyone promising fast results is likely selling an illusion. Building wealth on a low salary is possible, but it requires discipline, patience, and emotional control. It requires focusing on what you can control, your savings rate, your behavior, and your long-term decisions, instead of what you cannot control, like market movements or economic cycles. Charlie Munger's philosophy is not exciting, but it works. It is built on realism, humility, and long-term thinking. Wealth is not a sprint. It is a marathon of consistent, rational decisions made over many years. If you adopt this mindset early and stick with it, income becomes less important than behavior. And over time, even a low salary can turn into lasting financial independence.